Okay, a big trader just got their silver short position frozen at the worst possible time. And the official story everyone's pushing is, it's just normal ups and downs in the market. Nothing special. I wasn't even going to talk about this. I'm standing here with coffee that's already cold, acting like it's a regular day. I'm scrolling and I'm like, what just happened with silver? It bugs me because the big headlines are telling you a nice simple story, but I think you deserve to hear the whole thing. So here it is. It's Friday, February 6th, New York time. Before we go on, drop a comment with what day and date you're watching from because I love seeing how far this reaches. Quick thing, I'm trying to stop copycat channels that steal our stuff. If you like what we do here, subscribe and comment Arjan AG. That's it. It really helps. What's going on with silver right now isn't a small bump. It's not a tiny wiggle on the chart. One trader in Shanghai built a short position that was so huge, it was bigger than all the silver the exchange said was sitting in its warehouses. So the exchange or the regulators basically said, no more, freeze, you can't move. And the part that should surprise you isn't just the freeze, it's when it happened, how everyone can see it, and that everything else in the market already feels shaky. Let me explain 3 things quick, and I'll keep it moving because nobody wants a boring lecture. First, what this Shanghai freeze really means in simple words, and why it's a bigger deal than it looks. Second, why the just volatility explanation is easy but doesn't tell the full story, and what else it could mean. Third, what I'm watching next, because in a story like this, the next step matters more than what already happened. Okay, step back with me. We just went through one of those rough times where everything feels like it's falling apart together. People are saying worst day since the 80s and talking about a really bad recession that could hurt for years. And right in the middle of all that fear and confusion, this silver story pops up looking almost too perfect, like someone wrote it so regular people would look the wrong way. And that matters because silver isn't just a number on a chart. Silver is strange. When people get scared, it's like money. And when the world is building stuff, it's used in factories. Solar panels, phones, medical things, all of it. So when a metal is both a fear buy and a factory material, it acts crazy. It doesn't stay calm in a nice spreadsheet. Here's the main thing as people are describing it. One person on the Shanghai Futures Exchange built a short position that wasn't just big. It was so big you go, wait, how is that even allowed? And to make it more confusing, different reports spell the person's name different ways, so it's not clear which is right, but everyone says it's one person, one giant position, one problem, and it wasn't handled like a normal trade. They froze the account. The trader supposedly can't change the position for about a month. That's a long time. Long enough for the market to move a lot. Think about it. Being short means you're betting the price will drop. If the price goes up instead, you lose money fast. If you're short and frozen, you can't do anything to stop the bleeding. You're stuck on the ride with no way off. The simple bad guy story is he was trying to smash the price down. Maybe. But real life has other reasons too. Maybe hedging, maybe trying to make money on price differences, maybe a spread trade, maybe just a mistake that got huge. We don't know which one. I'm not inside his mind or his accounts. I'm just saying when a story sounds too clean and simple, you should at least leave space for another side. What we do know is they called it a naked short, meaning it wasn't clearly backed by real physical silver. And the answer was a freeze plus making it public. We also have numbers saying the position was in the hundreds of tons, while the reported warehouse silver was only low hundreds of tons. That means the short was way over 100% of what was supposed to be there. Not just a little over, but deep into who even allowed this territory. From the latest inventory updates, the silver pile was already small, then it got even smaller. And that's why this isn't just about one trader, it's about trust. When people start doubting there's really enough silver, they stop trading price and start trading fear of missing out or being left with nothing. Then, to make it worse, a big piece of the remaining silver suddenly got taken out of the Shanghai vaults, something like a fifth of what was left, more or less. That matters because if the total silver gets smaller while the short stays the same size, the short looks even bigger and scarier on paper. It starts looking like 1 1/3 times what's left, not just barely over. Now the story gets more interesting. The position wasn't frozen quietly. It got made public. Reports say details came from anonymous people close to the exchange. That could be a real leak. It could be on purpose. It could be office politics. It could be a warning to others. We don't know which, but the result is the same. Now everyone knows there's a huge short stuck there that can't move. And what happens when you tell the whole market exactly where the trapped trader is? The market smells a chance. It doesn't always happen, but it can. People talk about maximum pain. I don't love that phrase because it sounds like internet talk, but the idea is real. If enough people think a short is trapped, they might push the price higher to make him cover. That's a squeeze. But wait. Before we get too excited like it's a game, remember, silver is one of the easiest markets to move with borrowed money. That's the other half of the story, and most people skip it because it's not exciting until it hurts. There are basically two worlds, the paper world and the physical world. In the paper world, you're not buying real bars. You're buying futures contracts, promises. You put up only a little money to control a lot more silver. That's leverage. Leverage feels great until it traps you. When prices swing hard, exchanges raise margin. They say, give us more money as safety. If you can't add the extra, they force you to sell, even if you don't want to. Forced selling is real. It's built into the system. And we're hearing there were several margin increases close together, taking effect after today's close. Silver's margin jumped way more than gold's, which shows they're trying to calm the crazier one. That matters because stacking margin hikes on top of wild swings can knock out a lot of leveraged trades. And the ones who get knocked out are usually not the huge banks with endless money. It's the smaller players who thought they were investing, but were really just renting a bet. Am I saying margin hikes are bad? No. Markets need rules, but I am saying they have real effects. And when you look at how silver moves around margin changes, it's not crazy to think these moves can work like a pressure release, or, if you're feeling suspicious, like a control lever. I'm not blaming any one group. They're all wonderful. They all wake up wanting to help people, just like every hedge fund guy is basically your best friend. So, we have the Shanghai freeze on one side, and Western markets tightening margin on the other. And then, because life loves mess, there's a headline telling people to leave Iran. We're not checking if it's true here, just following the story. But headlines like that can make people want safe things fast, and when safe demand jumps, gold and silver can go up quick. Now you have things pulling in different directions. A trapped short story that can make people buy, margin hikes that can force selling in paper, and fear headlines that can make people grab real metal. And right in the middle, the price is jumping around like crazy. People are saying we saw a few dollars rebound today, and it's back above where the year started. Double-digit % moves are normal now. And yeah, that happens whenever too much borrowed money piles into a market. One day up big, next day down big, and suddenly a 10% move feels like normal news. Here's what people miss. Big swings don't just scare people. They move contracts around. They move patience from people who can't wait to people who can. They move stories too. The winner isn't always the smartest. Sometimes it's just the one who isn't forced to sell today. Another detail, the trader supposedly made a ton of money, hundreds of millions, during a fast drop earlier. Currency not said. And that's important because if you're wondering if money can leave the country, you care what money and where. But we don't know, so we leave it unclear. The point is he supposedly won big when price fell hard, and now if price goes back up, he's stuck and can lose it. That's the danger. And if the market thinks he's trapped, the market will test it. Not because markets have feelings, but because markets look for easy money. This isn't personal, it's just hunger. A quick history note to help your brain remember. We've seen crazy big bets in metals before. We've seen single trades turn into big arguments. We've seen exchanges step in when things look like they might break everything. Names and years change. The pattern stays the same. Borrowed money builds up. Easy trades disappear. Rules get changed. People who didn't get the rules learn them the hard way. That's why I keep saying don't just watch price. Watch the boring stuff. Inventory, margin, how much real silver is around. That's where the real story hides. So when someone says a trader shorted more silver than exists, ask right away. In paper market or physical market. In paper, you can stack promises on promises on promises. That's how derivatives work. Physical is slower and harder. You can't make a bar out of thin air. You can fake a promise, but not the same thing. And here's where I want to push back on something people assume too fast. They hear short frozen and think silver has to shoot way up. Maybe, but not for sure, because the price most people see is driven a lot by paper trades. If margin hikes force people to sell, price can drop even when real silver is tight. That's the weird double life of silver, so it's possible to have vaults emptying out while the screen price gets hit hard. Confusing? Yes. Normal for this market? Yes. Now let's talk about that vault removal because it keeps bugging me. If a big chunk leaves right after the story breaks, a few things could be true. 1. Normal moving around. Metal gets shifted, checked, sent somewhere else. 2. Someone is taking real silver because they don't trust paper anymore. 3. Someone wants less visible silver because less visible silver makes squeeze talk stronger. We don't know which, but the fact it's getting attention means it's being used to make the story feel tighter. And that brings us to the leak. People say making it public was a message. Don't try this again. That makes sense. Regulators like scaring people straight. Public shame works. But even if it was on purpose, the reason could be bigger than just punishing one guy. It could be about keeping the market looking good. It could be warning others. It could be inside fights. We don't know, so we don't pretend we do. Okay, so what do we do with all this? First, if you're trading silver with borrowed money, know the rules can change any minute. Margin can jump, easy trades can disappear, gaps can get huge. If you're on the wrong side, you don't argue, you just pay. Second, if you hold real physical silver, your world is different. You care less about daily noise and more about can I get it, how much extra, how long to wait. In crazy times, real silver can move different from paper price. That's not a secret plan. It's just supply meeting panic. Third, if you're just watching, this is a perfect example of how clean stories get built. The official version is usually the simplest one, not the fullest one. Volatility happened, big trader got stuck, regulators helped, all that can be true on the surface, but the why and what happens next is where you get real understanding or get thrown around. Now, some new background that helps if you're trying to get the big picture. We just came out of a time when everything risky was priced like nothing could go wrong. Cheap loans taught people to buy every dip and ignore swings. Then money got tighter, and anything built on borrowed cash started cracking. You saw it in tech stocks, crypto, some loans. When borrowed money unwinds, it doesn't do it gently. It breaks fast. And metals sit in a strange place in that. They can be the safe thing people run to, but they can also be the thing people sell fast to cover losses somewhere else. So you can see gold and silver drop on a scary day just because someone needs cash now. That doesn't kill the long story. It just means forced selling is real. You also have real factory use that isn't going away fast. More electric stuff, better power lines, green energy gear, big computer buildings. Even if the words sound overused, the actual building is happening and silver is part of it. No single use is giant, but together they add up. On top of that, governments are talking more about important materials. Not about one specific rule here, just bigger picture. Everyone learned supply lines can be used as weapons. When that happens, people start thinking about keeping extra stock. That's not just silver, it's all commodities. So when someone says fundamentals didn't change, I get it, but be exact. Fundamentals can stay good while price goes wild. Both things can be true at once. That's why managing risk isn't optional. Back to the trader, because people love the human part. We're told he lives in Europe now. We're told it's not clear if regulators will let the winnings leave China. That's interesting because it shows this isn't only a trading story, it's a country control story. It's a who has power story. And if you've watched markets during tension between countries, you know, money moves easy until it doesn't. Rules stay hidden until they hurt. That's why remains to be seen matters. The ending isn't only about price, it's about permission. Do I think this one frozen short will decide silver's whole future? No, that's too much. Markets are bigger than one person, even a big one. But does it matter? Yes. It shows how the exchange will step in and how okay people are with huge bets. If authorities really start stopping giant naked shorts, that changes how people act. It might make them less bold or push them to hide better. We don't know. But when real consequences show up, behavior changes. And now the part everyone wants, a prediction. I'm not giving you a clean number like it's easy. People are talking about silver hitting 100s or even low 200s in a big run. Not impossible. Also, not promised. Market can make you look silly either way. What I will say, if swings stay big, expect more wild days from headlines, more margin changes, people freaking out over inventory news, and everyone calling victory on green days and doom on red days. So here are the real things I'm watching, and you can watch too without special access. 1. After the freeze, do we see steady buying or does paper selling push it down? Watch how price acts near big contract dates and margin changes. You don't need to be an expert, just notice patterns. 2. Do vault amounts keep dropping or level off? If they keep dropping, it adds power to the tight supply story. If they stop, squeeze talk gets weaker. 3. Does the exchange let the freeze end early or keep it the full time? If they keep it, more worry. If they end early, maybe it was just a warning. 4. Do scary world news keep growing or calm down? Safe buying comes in waves. When the wave hits, metals jump. When it fades, people forget. Now, I want your thoughts on 2 things. First, do you think making it public was a real leak or a planned warning? Comment what you think. Second, if you had to choose, do you think silver's next big move is up in a squeeze or down from more forced selling? And tell me why in simple words. One more thing, I see this a lot. If you're doing well, share your story in comments. It helps others who feel stressed. Real stories matter. A lot of people keep comparing this to the opposite of the Hunt brothers. Here's how I see it without the big drama. That old story was about one side trying to own a huge amount to push price up. This is being called the mirror, because someone supposedly pushed price down with a huge short. Okay, the mirror thing is nice, but the real lesson isn't up or down. It's concentration plus borrowed money plus a small market equals easy to break. That's the point. Silver isn't as big and deep as people think. It can move. Add paper bets on top, and it moves even faster than real metal can keep up. That's why you get those huge, fast candles that feel like gambling. And that leads to the idea people keep saying the world is running out of easy silver for regular buyers. Proof inside the story isn't clear, but the actual thing is real. Wholesale can look okay while store shelves and online dealers run low because the problem isn't metal in the earth. It's making coins and bars, shipping them, and dealers charging more during chaos. So if you're thinking, I'll buy when it dips, I do it too. Understand paper dips don't always mean cheap, real silver right away. Extra costs can go up. Supply can get tight. Wait times can grow. That's why people get mad. They see low price on screen, but can't get the real thing easy. That gap matters. Now about that fast crash and the profit, because it sounds like a movie. We're told silver dropped hard and fast. Mid-teens % in some stories, almost a third in others. Vague but simple meaning, borrowed money makes pain bigger. A move that looks okay on normal price can wipe you out if leveraged. That's why I keep saying it. If you use leverage in silver, you're choosing to walk on a wet floor, then acting surprised when you slip. Don't do that. The trader supposedly made money in that crash. Now, with the position frozen, we might see if those wins were real and safe or just numbers on paper that can disappear. Because an open profit is just a dream until you close and take it. If you can't close, the dream can turn bad fast. One more warning, don't assume regulators want you to win. They don't care about longs or shorts. They care about things looking stable, looking good, and staying in control. If a squeeze would make the exchange look bad, they might stop it. If a short would break things, they might stop it. Their goal isn't your money, their goal is the system not falling apart. So what happens next? We have about a month where, if the story is right, the trapped position can't change. That's like a timer everyone watches. Every inventory number and margin change will feel like a new episode. In the West, margin rules matter. More hikes can limit wild buying. They can also push people out of futures. In Shanghai, publicly calling out a huge short matters. It may make people less brave. In the real world, recession talk matters because it changes what factories want. Slow factories mean less silver use. More government help means more use. Energy projects continuing means steady use. This isn't one thing. Quick check, there's a big drawdown number people repeat, but they don't say starting from what. That's key. Big % sounds scary without the base. Same with the trader's name spelled different ways. Doesn't kill the story, but shows info is messy. Messy info twists stories. So here's my take. And I'm saying it's my take. A trader built a giant short in Shanghai silver futures. The exchange or regulators froze it. The freeze went public. Visible silver looked like it dropped. Western futures raised margin quietly. World fear headlines added safe buying. Price swung hard, hurting leveraged people and helping patient ones. That's it. Not magic. Not one reason. Lots of things hitting at once. What should you do? Depends if you're trading, investing, collecting, or just curious. I can't choose for you, but here's a rule that works almost always. Don't let your bet size control your feelings. If a price move ruins your day or sleep, it's too big. Make it smaller. You'll think better. And if you've been buying real silver for years, you know this is a long game. You remember when prices felt dull. You remember when $100 silver sounded like a fairy tale. Now people say those numbers seriously. That shows how fast feelings can flip. So here are the main takeaways. 1, the freeze matters because it proves they can stop big bets and shows weak spots. 2, inventory changes matter because they build or kill trust and squeeze feelings. 3, margin matters because it's the quiet force that makes people act when they don't want to. 4, world news matters because fear moves metals fast. 5, the market can be right long-term, but still hurt you bad short-term if you're using leverage. If this helped you, subscribe. It's free. It keeps the channel going and helps us fight lazy stories. And don't forget, comment our John AG if you support stopping copycats. All right, I'll keep watching updates just like you, and I want your thoughts and comments, especially if you think the public story was a real leak or a warning, and if you think next big move is up or down. And to be super clear, because I care about this is just info to help you think. I'm not your money advisor. I don't know your life. Nothing here is advice to buy or sell. Decide for yourself. Take care of your risk.